Hello, everybody. This is Patrick MontesDeOca with Ima to Trade Live. On this podcast, I would like to share with you a report that we just published on Seeking Alpha on February 19th, 2018. Is gold on the way to 1400? October the 10th, 2017 report confirmed. I would like to review the 180-day cycle since we published the report, long-term gold forecast, on October 10, 2017 on Seeking Alpha. In the report I wrote, based on the IMA to Trade proprietary VCPMI, I analyzed the levels of supply and demand for gold that I expect to see for 12 months from September 28, 2017 to September 28, 2018. As we look at the 6-month or about 180-day cycle we published on the report, I would like to bring you up to date and see what has transpired since we made the forecasts using the VCPMI automated algorithm. On September 28, 2017, gold closed at $12.88. Trading above the 50-day moving average of $12.53 and above the longer-term moving average of $12.64, which indicated that the momentum was very bullish. And based on identifying the average price, which was roughly $12.69, we were able to identify the extreme of the relative implied volatility of the supply and demand target levels to be at $1,386 an ounce to $1,484 an ounce. These are levels coming into this cycle period for 2018. The current market high of about $13.70 as of January the 25th was close to the target of $13.86 that we identify as the sell 1 level of the 360-day cycle that started back on September 28, 2017. The sell 2 objective currently is at $14.84. The rally that we saw in gold since December to the recent highs at the end of January 2018 anticipated the economic numbers as they relate to inflation, which is the beginning to confirm that the world economies, in particular the US, are picking up the inflationary levels, which the Federal Reserve has been anticipating for the past couple of years to justify increasing interest rates. We saw inflationary spikes due to the weakness of the dollar, which indicates that we could be entering pretty much an inflationary period that we have not anticipated before due to the fact that the economy has been on a deflation cycle since the 2018 recession. And if you look at the stock market, I consider it to have been completely inflated due to the low interest rate environment that has been created since the Great Recession of 2008, making money very cheap for Fortune 500 companies to borrow and then buy back their own stocks, which has been fueling the stock market for the past few years. Inflationary factors that seem to be surfacing are putting pressure on the Fed to raise interest rates as a consequence. The strength of the world economy also has given world central banks a reason to raise interest rates. I think a serious global problem is that the central banks are caught between a rock and a hard place. On the other hand, governments are running massive debts, spending is uncontrollable, and therefore world debt increases, and the cost of this debt is beginning to grow exponentially. Japan is an example of the monetary policies of low interest rates that have not really helped stimulate the Japanese economy. If the cost of money begins to increase, it is going to put tremendous pressure on the sovereign debt of world governments. But the amount of capital that is at risk in derivatives, for example, which is in the excess of $1 quadrillion, are subject to default if we see an accelerated increase in interest rates. It is my opinion that as much as we hear the rhetoric of the central banks about plans to raise interest rates aggressively, I believe it is simply rhetoric. Economic transformation. I believe that the fabric of the global economy is on the verge of a transformation which will greatly affect the bond and world real estate markets. As we see the cost of borrowing increase as interest rates rise, the world sovereign bond market is facing huge losses in terms of loss of principal as interest rates rise due to the inverse relationship between bonds and interest rates. We have a really precarious situation. In some cases, we have seen deflation, such as when you look at the price of commodities since 2018 and interest rates, which have all been in a deflationary cycle. In comparison, the stock market prices, securities, and real estates have been in an inflationary cycle, reaching new highs. What we saw recently with the recent sudden and dramatic decline in the stock market around the world, setting new records for one-day drops, is the first hint that we're going to see an increase in the volatility of most of these assets that we have been manipulated by the low interest rate policies. The value of interest rates, precious metals, and other assets such as silver and gold, and mining shares have been suppressed against the natural trends. Once they are interpreted as risk assets, the price should move substantially higher. Debt levels are running at 60 trillion on a global basis, with even if the world economies take a long time to be able to pay off this debt, particularly in a higher interest rate environment. I believe that the gold market is beginning to price in the fact that the US dollar has entered an acceleration period to the downside. It indicates, as I have argued in earlier Seeking Alpha reports, that we have been in a downtrend since 2017, which could reach levels in the low 80s on the dollar index. And in the short term, we're looking for the US dollar to descend into the month of May before we see any kind of support fundamentally. The CPI is a lot stronger than anticipated, and we see more inflationary talk hit the markets, all of which is extremely bullish for the price of gold. Before we take a look at the Commitment of Traders report, let's take a look at the economic data that came out this week, which indicated that the inflation is rising and GDP is declining. On Thursday, we learned that the Consumer Price Index, the CPI, came in overheated at 0.4%, and food and energy is annualizing at 2.2% inflation. What we have learned from the report is that the consumer and the producer price indexes, the CPI and the PPI, are rising, which are all but guarantees more interest rate hikes. I'm beginning to hear an alarm going off that we need to pay attention to as the market reacts, and in particular the stock market, to this aggressive environment of raising interest rates. With inflation while inflation is rising, other economic numbers are not all that good, as we saw the downgrade in retail sales in January, and in January's increase in utility production, which was smaller than expected, which I believe is going to lead to downgrade in the forecast for the first quarter GDP. Initially, the Fed's forecast for the first quarter GDP was 5.4%, which coincided with the top of the market. The Fed, however, has significantly lowered the forecast down to 3.2% since then. Pivot point for interest rates. I believe that we are at a critical point, a pivot point in interest rates as it relates to the stock market. The massive correction that we saw recently was simply the tip of the iceberg. If in fact the sentiment of the market begins to see the monetary policies have changed to a hawkish environment of rising interest rates, this could precipitate another massive sell-off in the equity markets. The market could easily develop resistance roughly around the 50-day moving average, which is now considered a major resistance level, and prices could come down from these levels to the 2000 moving average in the second wave correction. This leads us to believe that there is a shift in wealth taking place from the equity markets to risk assets, which as precious metals, gold and silver, if we look at the speculative positions of the Chicago Mercantile Exchange, the CME and the gold market, we can see that the commercials are reducing their short positions, and as of the last week reported, the net positions were 175,600 contracts, which had fallen from 190,900 the prior week, a decline of 15,300 contracts. It seems to indicate that the commercials are beginning to cover short positions, and it is very supportive to the market moving forward. The VCPMI and the gold market. I would like to look at the variable changing price momentum indicator, VCPMI proprietary algorithm, and what it is telling us as we come into the next week for the price of gold. For those interested in finding out more about the VCPMI automated algorithm, we have just published a book, Mean Reversion Trading, and please go to our website, imatotradelivesignals.com. Go to the contact page if you would like to, or just send us an email to support@imatotradelivesignals.com, and we'll be glad to send you a free copy. The first 100 subscribers, you might say, would be able to receive a free copy. The variable changing price momentum indicator is basically an automated, intelligent, algorithmic trading system developed and tested over a decade. The primary driver of the VCPMI is the principle of the reversion to the mean, combined with a range of analytical tools, including fundamental logic, wave counts, Fibonacci ratios, Gann principles, supply and demand levels, pivot points, moving averages, and momentum indicators. The science of vortex mathematics is used to combine these various elements into a comprehensive, accurate, and predictable automated AI trading system. 1. The VCPMI relies on technical analysis to analyze markets and predict future movements, which seem to determine what a security is worth at a given point in time. Such an approach uses historical prices and indicators to identify zones of supply and demand where buyers and sellers are likely to change the price of the financial product in an attempt to predict future price movements. The VCPMI uses analysis, technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular security based on the assumption that it will revert to its previous state. This theory can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when a security or commodity is trading at an abnormal level. One of the outstanding features of the VCPMI automated algorithm is the ability to forecast accurately the supply and demand levels for the next trading day, week, or monthly session for securities and commodities. By identifying the average price, or what is called the mean or equilibrium of price action based on yesterday's supply and demand factors, the VCPMI extrapolates the extreme above and below the average price or mean equilibrium specifically and precisely. Once the algorithm identifies these levels, it creates a specific set of instructions to execute the signal once certain criteria are met. When the signal is executed, the VCPMI automatically produces a specific price target, objective, and stop protective levels for you to revert back to a neutral position and wait for the next signal. Designed for short-term, intermediate, and long-term traders. The VCPMI produces a trading structure of 5 levels of supply and demand, daily, weekly, and monthly. The mean or the market price, 2 buy levels below the market, buy 1 and buy 2, and 2 sell levels above the market, sell 1 and sell 2, or the equilibrium or the average price. When prices trade at these extreme levels above or below the mean, it is between 90 and 95% probable that prices will revert back to the mean or equilibrium by the end of the trading session or period. The VCPMI prepares you ahead of time, prospectively, which levels to execute for the next trading session. By removing the guesswork and random trading out of your trading strategy, you become an executor. In essence, a real trader, instead of trying to analyze where the market is going minute by minute, day by day, and month by month. Chances are that by the time you find out where the market is going, by using conventional forms of analysis or wisdom, it will be too late, especially in today's rapid electronic environment where a second can make a difference between a fortune gained or a fortune lost. In taking a look at the supply and demand levels for next week in the report we published for our subscribers on February the 16th, 2018, the gold futures contract closed at 1356. The first filter that we use for the VCPMI is the weekly trend momentum, which identifies the sentiment of the market. With the market closing at 1356 on Friday, it closed right at the 9-day moving average of 1356, which indicated a bullish sentiment. The filter also tells us that if the market were to close below 1356, this bullish sentiment would turn to neutral. This is the first level that you can use as a weekly protective stop for any long positions you hold. The second filter that we use is the mean or the average price, which was 1345. Once we have identified the average price, we can extrapolate the extreme above and below the average price. This report provides a lot of information for self-directed individuals with a high degree of accuracy. The fact that the market closed at 1356 above the weekly moving average of 1345 indicates that the market is bullish coming into this week. With the VCPMI algorithm, we're able to it's able to tell us basically the targets above the mean at which to take profits by exiting long positions at the sell 1 level of 1375 and the sell 2 level of 1393 coming into this week. The algorithm very specifically identifies this week that the targets are located, where they are located. If we close below 1345, the average price, the bullish weekly price momentum will be negated to neutral. And if it were to close below 1345 the second time in a row, it would indicate that traders should exit their short positions if you go short at the 1327 to the 1392, which is the buy 1 and buy 2 level. The third filter specifically tells you that if you go short the market, precisely where to cover your positions. Coming into this week with a bullish sentiment, the algorithm recommends taking profits at the sell 1 and sell 2 levels at 1375 to 1392. My conclusion is that if we take into account the economic indicators that seem to forecast higher inflationary levels, it appears that the pressure is growing on the low interest rate monetary policies being pursued by central banks around the world. I feel that the price of gold is beginning to anticipate higher inflation, and the expectation of higher interest rates, which is the risk factor in the price of gold, is leading to a bullish adjustment in prices. We must take into consideration the suppressed state precious metals have been in for the past few years against the natural mean or the average price of gold. And I do not think that we have seen the total transparency in the price of gold in relation to debt and interest rates levels yet. As stock markets, investors begin to realize the consequences of higher interest rates and the massive potential repercussions across global economies. They will turn to the area that seems to be the most undervalued and which also offers a historical safe haven during economic crisis or uncertainty and devaluations of currencies, and that's precious metals. And I believe we're going to put the spotlight back once again on gold and silver as a hedge against inflation, uncertainty, and any unprecedented economic and political development, specifically the current tax cuts, which is another way of quantitative easing. As we come into next week, basically there is a highly probability that we could reach the 1386 price of gold that we anticipated back in September 2017. And if you're long in the market, I suggest to use these levels. You can use these levels to hedge or to protect a portion of your profits as we begin to enter an area of supply that essentially is the long-term resistance levels that we are able to identify between 1386 and 1484. If you like this podcast, please subscribe. We would appreciate, just click on the link, subscribe, like, and we will continue to provide you with this tremendous information for self-directed individuals.